Welcome to the Explainer. Today we're going to unpack the actual financial mechanics that keep a company alive and kicking. So, whether you're a seasoned entrepreneur or, honestly, just sketching out your very first startup idea on a napkin, understanding how money moves through an organization, well, that's literally the ultimate key to survival.
So why do even the best business ideas fail? Have you ever wondered about that? I mean, it's a tragedy we see all the time in the market. You can have this revolutionary product, an incredibly talented team, and a perfect product market fit. But if you run out of cash, the dream dies. To put it simply, brilliant ideas fail when they run out of blood.
Okay, let's dive into this anatomy of a healthy business. We're going to hit 5 key areas today: the lifeblood of business, where the money goes, equity versus debt, short-term survival, and finally, long-term growth. Let's get right to it.
First up, Section 1, the lifeblood of business, looking at finance as the circulatory system.
Now, finance isn't just dry math staring at you from spreadsheets in some back office. It's the vital, pumping energy flowing through every single department of a company. Let's define exactly what we mean here. Business finance is basically how a company manages its money, including how it acquires, uses, and controls financial resources. And I really want to put a major emphasis on that word controls, because effective financial management, knowing exactly where your resources are and how they're working for you, is quite literally the difference between a business thriving and a business dying.
So there are 4 core involvements in this whole process. You've got raising capital to get money in the door, managing costs to keep it from bleeding out, planning for the future, and of course, ensuring profitability. Honestly, think of these 4 pillars as the heartbeats of the entire operation. If any of these stop pulsing, the whole system is in serious jeopardy.
Moving on to Section 2, where the money goes, distinguishing between survival and growth.
All right, once you've successfully pumped that money into the system, where does it actually go? Well, the secret here is distinguishing between mere survival and actual growth. Practically every dollar your company spends generally falls into one of 2 buckets. First, you have OPEX, or operating expenses. These are your recurring, short-term expenses. Think of them as the daily calories your business needs just to survive. Stuff like paying your tailors, keeping the lights on, or buying raw materials. Then you have CapEx, or capital expenses. These are your one-time, long-term investments. This is the muscle-building stuff, like buying brand new state-of-the-art sewing machines or opening up a whole new factory. You absolutely need both to function, but as you'll see, they impact your financial health in very different ways.
Which brings us to Section 3, equity versus debt. Basically, choosing your blood type.
So, when you need a massive transfusion of cash to cover those expenses, you basically have 2 choices. You either give up a piece of the pie or you borrow it. Here's the fundamental difference. Equity financing means you're raising money by selling ownership or shares in your business. You're bringing someone else along for the ride, like selling a stake to an angel investor or a venture capital firm. Debt financing, on the other hand, means you are borrowing money that absolutely must be repaid, and always with interest. That's your classic loan from a bank or issuing a bond.
Now, what's really interesting about this is when we weigh these options, the trade-offs become incredibly clear. With equity, the pros are fantastic, right? There are no mandatory monthly repayments to stress over, and you share the risk with your investors. But the downside? You dilute your ownership, which means you give up a chunk of control, and you have to share all your future profits. On the flip side, debt financing allows you to keep full 100% ownership of your baby, and the interest payments are actually often tax-deductible. But the catch is heavy. You must repay that debt no matter what happens to your sales, and that can put immense pressure on your daily cash flow.
All right, Section 4, short-term survival. The quick, fast heartbeats.
So cash flow pressure requires rapid responses, and this area of finance is entirely focused on bridging those temporary cash flow gaps of less than a year so you can, keep the lights on. When you need cash immediately, you have an arsenal of survival tactics at your disposal. Trade credit is incredibly common. It's essentially a buy now, pay later arrangement with your suppliers. And the best part is it's usually interest-free if you just pay on time. Then you have bank overdrafts and lines of credit. These offer amazing flexibility to just draw the exact cash you need right when a surprise bill hits. And hey, if you have a stack of unpaid customer invoices sitting on your desk, you can use factoring, which involves selling those receivables to a third party to get instant cash flow today.
But it's not all smooth sailing. So the crucial point is this: you absolutely must watch out for high short-term interest rates.
While tools like overdrafts and business credit cards are undeniably convenient for quick expenses, if you misuse them or worse, fail to pay them off quickly, those compounding interest rates can completely cripple your business. It's a quick fix that can very easily turn into a fatal long-term trap.
Next up is Section 5, Long-Term Growth, the slow, steady pulse.
Once you've mastered the art of short-term survival, you can finally lift your head up and look to the horizon. We're shifting gears entirely here, moving from rapid survival tactics to measured, visionary funding meant to sustain your growth over the next 10 to 30 years. And for that kind of grand vision, you need heavyweight financial tools. We're talking about long-term bank loans, issuing public debentures and bonds, utilizing lease financing so you don't have to buy massive equipment up front, or maybe even bringing in heavy-hitting venture capital. You definitely do not use these sources to cover next week's payroll. No, these are the massive cash injections you use to buy real estate, build completely new manufacturing facilities, aggressively expand your operations, or enter entirely new global markets.
But you know, one of the absolute best sources of long-term funding you can possibly have is internal financing. And this brilliantly illustrates why. If your company is already profitable, you can simply reinvest your own retained earnings back into the business. The incredible beauty of this is that it avoids both the crushing pressure of monthly debt repayments and the painful dilution of giving up ownership to venture capitalists. It is pure growth, fueled entirely by your very own success.
Okay, let's move to and see how this builds into a cohesive strategy using a real-world application. Take a successful clothing brand in Lahore, for example. First, they use their long-term capital, maybe a bank loan or their retained earnings, to buy expensive new sewing machines. That's the muscle, right? Second, they actively manage their short-term cash flow to ensure the tailors and staff get their salaries on time every single month. That's the daily calories. And finally, they use strict budgeting to launch a massive, well-timed marketing campaign right before Eid to drive huge sales. It's just a beautiful, chronological story of a brand using different financial tools to survive the day-to-day and then thrive season to season.
Which brings us to our final and honestly most important question for you to ponder. Are you actively managing your business's lifeblood, or are you just crossing your fingers and hoping you don't bleed out? Understanding the deep mechanics of finance, like the difference between equity and debt, balancing CapEx and OpEx, and knowing exactly when to use short-term survival tools versus long-term growth engines, these are the absolute cheat codes to business success. I really hope this explainer has empowered you to take control of those mechanics in your own ventures. So go out there, manage your resources wisely, and keep that lifeblood pumping.